Hey, what's up YouTube? In this video, we're going to talk about buying a house. Whether this is your first time buying or you've bought and sold a house before, you're going to want to watch this video. And stay tuned to the end where I share with you the one thing that will kill your chances of getting a loan more than any other thing, and people are still doing it. My name is Paris Clough, and this is Financial Self-Reliance. On this channel, we talk about the mindsets and the skill sets of the wealthy so that you can learn how to manage, protect, and grow your assets. If that sounds like the kind of community and the kind of channel you'd like to be a part of, go ahead and click like and subscribe so that you don't miss any of the videos that I produce. All right, in this video, I'm going to share with you 7 things that I think are really important if you're looking to buy a house in the near future, especially if you're going to be buying a house for the very first time. These are in no particular order, but they're all very important. The first thing you want to do is make sure that you can afford the payment. How are you going to know if you can afford the payment? You've got to talk to a mortgage or loan officer and get an idea of how much mortgages cost. There's a few things that go into having a mortgage. The first is your principal payment. The next is your interest payment. The next is your taxes. And then you have to have insurance, what's called PITI, principal, interest, taxes, and insurance. All 4 of those things make up your mortgage payment. So it's important that you ask for your loan officer to give you a quote on how much a mortgage would cost with all 4 of those elements included. Now, you don't have to include all of those elements with your payment. You could only pay your principal and interest to the mortgage company and then keep your taxes and insurance and pay them separately. But a lot of people bundle it together and make it super simple, and then the mortgage company pays your taxes and insurance for you. That makes it really simple and really easy. But either way, you've got to make sure that you can afford your principal, your interest, your taxes, and your insurance. If you can't afford all those things, then you may not be able to afford the mortgage you're looking for. Another thing that goes into the mortgage payment could be what's called primary mortgage insurance. If you don't put more than 20% down, you're going to pay primary mortgage insurance on top of those other things. It's critical to understand what goes into your monthly mortgage payment so that you can make sure that you can afford it. One of the critical elements to all of this is having good credit. So you've got to make sure that your credit is clean. I highly recommend the free credit report companies. One that I personally use is Credit Karma. But a lot of credit cards now and other banks are letting you use a free credit reporting agency so that you can look at your credit, you can see what's on there, see what you need to do to improve, and make steps to improve your credit as soon as possible. The higher your credit score, the lower your interest rate will be. The lower your interest rate is, the lower your principal and interest payment are going to be. And that all wraps into the total payment that you're going to have. So it's very important to have really good credit. The third thing is making sure you have a good down payment. Now, a lot of people don't realize that with an FHA loan, if your credit isn't that good, or if you don't have a lot of money to put down on a property, like that 20% I talked about earlier to avoid the primary mortgage insurance, you can still buy a house with an FHA loan, putting only 3 or 4% down. That's a really amazing program for people who don't have a ton of money to put down but still want to be able to buy a house. The important thing there is, though, the more money that you finance, the larger your monthly mortgage payment is going to be. So you got to, again, make sure that you can afford the monthly mortgage payment. I just want to put in a side note real quickly, though, that the interest that you pay on your mortgage payment can be tax deductible. You'll have to confirm that with your tax preparer or your CPA. But depending on how you itemize or depending on what your standard deductions are, you can probably get some of the money that you're paying towards your mortgage as a tax write-off and reduce your taxes. So that will help towards being able to afford that mortgage payment. Let's say you're renting a house right now for $1,000 a month and your mortgage payment would be $1,200 or $1,300. You're nervous about having an increase in your monthly mortgage payment of $200 to $300. Well, some of that money is going to be able to be a tax write-off, so you'll get it back in your paycheck because you can claim more on your taxes, and then at the end of the year you might get more money back because they let you write some of that money off, and so it might even out, or at least help subsidize that extra $200 or $300 a month that you might be nervous about. So that's something to think about. If you're getting value out of this video so far, I really appreciate if you smash the like button. It helps the YouTube algorithm get this video out to more people who are also looking for good advice on what they need to do in order to be prepared to buy their first home or buy their next home. Something that's really important that mortgage companies are really looking for right now especially is they want to make sure that you have at least 4 to 6 months worth of reserves. So if your mortgage payment is going to be $1,500 a month or $1,000 a month, they need to make sure that you have 4 to 6 times that dollar amount in reserves. And reserves means like an emergency fund or in a savings account where you can access it quickly. They don't want people to lose their job and then not be able to pay their mortgage or have to deal with more forbearances than they're already having to deal with already. Right now, in 2021, if you want to buy a home, you need to have 6 months of reserves, 6 months of that mortgage payment in a savings account where you can access it in case of any problems that you come across. I reached out to a loan officer friend of mine, and that's what he told me, was that you need to have 6 months So making sure that you have your emergency fund in place is critical to being able to qualify for a loan. All right, the fifth thing I wanted to share with you is to make sure that you have all your paperwork in order. The last thing you want to do is show up to your mortgage guy with a box full of papers and or the incorrect information, so it takes him or her even longer to be able to make sure you qualify for your loan. Especially nowadays with a lot of people with side hustles. If you're expecting to use your side hustle income as part of your income to qualify for a loan, you're probably going to find out that if you haven't been doing that side hustle for at least 2 years and have taxes to prove that you've been making money at that side hustle, you're not going to be able to use that money to be able to qualify for that loan. So that's important to remember, is that if you do have, or if you have had a side hustle for at least 2 years, you're going to have to make sure that all your paperwork are in place, all your receipts, all your income. They want to make sure that you're making money right now, not that you made money in the past. So right now, what a lot of mortgage companies are requiring is what's called a profit and loss statement. So they want to know how much money you've made year to date, what your expenses have been year to date, what your gross income versus your net income is on your business income. That's your side hustle and business income that's apart from your job. If you have a W-2, it's super easy. You just give them your paychecks and your pay stubs, and right there they know exactly what to do. But if you have a business or a side hustle, you're going to need to show that you're profitable in your business, especially if you want to use that income to qualify for that loan. Another thing a lot of people forget about right now is that not only do you have to have money for a down payment, not only do you have to have money in reserves, but you have to have money for closing costs. Now, in a lot of cases, you're able to split the closing costs with the seller of the house. But in this market, where it's a buyer's market, in order to win the bid, you might have to concede to pay all of the closing costs so that your bid becomes more attractive to that seller. So you're going to have to be aware of the closing costs that are also involved with getting that mortgage. This is a lot of information and it might feel overwhelming, but it's important to know exactly what you're getting into ahead of time so that you're ready for it and you're prepared for it, at least more ready and more prepared than you would have been had you not watched this video. Another thing to remember about buying a house and buying a home is that you are now the landlord. You can't call anybody else to fix the toilet, or if something breaks, you're now in charge of that. So you're really going to need to make sure that you have that emergency fund. Anything can happen when you're a homeowner. Someone can slip and fall. That's what homeowners insurance is for. If you have a fire or something burns down, homeowners insurance takes care of those things. But if you have a sprinkler head break, or if you have a toilet overflow, or you have something snap or break, or something, a hose do something strange, you're going to have to pay for that and hire a plumber or hire a handyman to come out and fix those things for you, unless you're handy yourself and you can learn how to do it yourself. There's a lot of great videos on YouTube for do-it-yourself type of work. If that's the kind of person you want to be, then you'll be able to learn a lot of great things as a homeowner. I know since I've owned a home, I've learned how to do a lot of things on my own and to try to save myself a few dollars. There's also some things that I realized that I should just pay somebody else to do it, because the headache isn't worth it for me to spend hours and hours and hours to try to figure something out when I can just pay somebody and they can come out and figure it out right away. So those are the types of things that I would say that you really need to consider when you're looking to buy a house. Make sure that you can afford the payment. Make sure that you're having good credit. Make sure that you have enough money down. Make sure that you have enough money in reserves for that mortgage payment. Make sure that your paperwork is in order, that you have everything you need to be able to qualify for that loan and prove the income that you have. Make sure that you're going to have closing costs. You're going to need to have money on top of the down payment, on top of the reserves, to be able to pay those closing costs. And finally, make sure that you keep your emergency fund as full as possible for any new and exciting emergencies that you're going to find as a homeowner that will invariably come along. Now, I promise you the one thing that people do, and they still do today, that will kill your opportunity to get a home loan more than anything else, and I can't believe people are still doing it, and that is making a major purchase in the middle of a mortgage. See, when you buy a home, it's a 30-day escrow or a 45-day escrow. What that means is it's 30 to 45 days before the house actually becomes yours and the loan closes. If you got under contract to buy a house today, and your lender said you qualified, everything looked great, your credit score was excellent, you had all the money that you needed in place to be able to pay for the closing costs, the down payment, everything we've talked about. You win the bid, the seller of the house chooses you to buy that house, you're all ready to go, everything's set, and you now want to go out and buy a new truck, or you want to go buy some furniture to put into the house. Don't do anything until the loan of your mortgage closes. Once the loan closes on your mortgage, then go buy the new truck, go buy the new car, go buy the new furniture, then go buy the new TV, then go buy the new flooring. Don't do those things while you're in the middle of your loan. If you do something like that, it will lower your credit score in the middle of the loan, and then you won't qualify because at the end of the loan, right before they fund the loan, right before they make sure that they give the money to the buyer and you can move in and get the keys, they'll check your credit score again. And if your credit score has dropped dramatically because you bought a new item or you've gotten a new loan, or you've accumulated some other debts because you're buying other things to put furniture in the house or to buy a new truck to be able to do the yard work that you've been wanting to do, you're gonna lose the loan and you're not gonna qualify. If you feel like you're gonna be buying a house soon, in the next month or 2 or 3, don't make any big purchases because your credit score needs to be strong ahead of going into the loan. Wait till the loan closes. Once you have the house, once you have the keys to the new house, then go buy everything. Don't do it in the middle. I hope this video was valuable. If you got a lot out of it, click the like button, click the subscribe button, and share this video with a friend of yours that's looking to buy a new home or wants to buy a new home in the near future. I hope you have a great day, and I'll see you on the next video.